What Warren Buffett warns investors not to do in 2026. Have you ever wondered why some investors build wealth while others lose everything, even in the same market? The answer isn't about finding the next big stock. It's about avoiding critical mistakes that can destroy your financial future. Did you know that during the last major market correction, everyday Americans lost over $2.1 trillion? That's not just a statistic. That's retirement dreams vanishing overnight. Yet while most investors were panicking and selling at the worst possible time, Warren Buffett was doing the exact opposite, staying calm and looking for opportunities. The truth is, the world's greatest investor succeeds by following principles most people ignore. While financial headlines push you toward constant action, Buffett's fortune was built on patience and discipline that most find impossible to follow. In today's video, I'll reveal 7 critical warnings Buffett has for investors heading into 2026. Each one could save you from devastating mistakes that might take decades to recover from. And stay until the end for Buffett's most powerful advice, one that contradicts almost everything you're hearing from financial advisors right now. If you're planning to make any investment moves this year, type prepared in the comments, and let's dive into what the Oracle of Omaha wants you to know before you risk another dollar. Now, let's dive into the first warning from Warren Buffett, and it might challenge everything you're hearing on financial news right now. Don't chase the crowd and market frenzies. Warren Buffett has a famous saying that I've kept pinned to my office wall for years. Be fearful when others are greedy, and greedy when others are fearful. This simple phrase has helped him build a fortune, while others lost theirs by following the herd. Here's the plain truth. When everyone is rushing to buy the same investments, prices get pushed up far beyond their actual value. It feels safe to follow the crowd. After all, how can so many people be wrong? But that safety is an illusion. By the time everyone is talking about an investment at family dinners, the smart money has already made their profits and is quietly exiting. Remember the dot-com bubble? While tech stocks were soaring and everyone was jumping in, Buffett stayed completely away. People called him outdated and out of touch. Financial magazines suggested he had lost his edge. But when the bubble burst, Berkshire Hathaway remained strong, while countless new economy investors lost everything. The same pattern repeated with crypto, meme stocks, and every other investment mania. The solution isn't complicated, but it requires mental strength. Instead of asking what's hot right now, ask what's valuable and underappreciated. Look for solid companies with strong fundamentals that aren't making headlines. When you hear people bragging about quick riches and some new investment trend, that's your warning sign to be cautious, not to join in. And speaking of warnings, let me tell you about the second trap that catches even experienced investors. One that could be especially dangerous in 2026's uncertain economic climate. Don't try to predict short-term market movements. The only value of stock forecasters is to make fortune tellers look good, Buffett once joked. Yet every day, financial media is filled with experts confidently predicting where the market is heading this week, this month, or this quarter. The uncomfortable reality is that nobody, not even Warren Buffett himself, can consistently predict short-term market movements. Markets respond to millions of factors, many completely unpredictable. Even professional forecasters with advanced degrees and powerful computers get it wrong most of the time. Consider this. A study by CXO Advisory Group tracked 6,582 predictions made by 68 financial gurus. Their accuracy? Just 47%, worse than a coin flip. Even the most successful forecasters were right barely 60% of the time. Buffett understands this limitation and doesn't waste time or money trying to time the market perfectly. Instead of trying to predict market movements, Buffett focuses on finding wonderful businesses at fair prices. He looks for companies with durable competitive advantages, honest and capable management, and reasonable valuations. Then he holds them for years or even decades, allowing compound growth to work its magic regardless of short-term fluctuations. Here's a simple approach you can follow. Make regular investments in quality companies or index funds regardless of what the market is doing. This strategy, called dollar cost averaging, naturally buys more shares when prices are low and fewer when they're high, without requiring any market predictions at all. Now, let's talk about the third warning that's particularly relevant in today's high-interest environment. Don't borrow money to invest. If you're smart, you don't need leverage. If you're dumb, it'll ruin you. Buffett has bluntly stated, when interest rates rose and markets became volatile, this wisdom proved painfully true for many investors who borrowed to amplify their returns. The math seems tempting at first. Borrow money at 6% to invest in something that might return 10% or more. But here's what the investment seminars don't emphasize. While leverage multiplies your gains when things go right, it also multiplies your losses when things go wrong. And in investing, things go wrong with surprising regularity. Take Michael's story, a successful doctor who borrowed against his home in 2021 to invest in growth stocks. When the market turned in 2022, he didn't just lose his investment. He still owed the original loan plus interest. What would have been a recoverable market downturn became a financial emergency that forced him to sell at the worst possible time, locking in permanent losses. Warren Buffett built Berkshire Hathaway into a financial powerhouse while maintaining remarkably low debt levels. He understands that financial independence means having options, and debt removes those options. When you invest without borrowing, market downturns become opportunities rather than emergencies. The solution is straightforward. Only invest money you actually have and can afford to commit for the long term. If an investment seems attractive but requires borrowing, it's often better to save up and invest later rather than taking on the additional risk of debt. Have you ever been tempted to borrow money to invest in what seemed like a can't-miss opportunity? Drop leverage in the comments if you'd like to hear more about safer ways to maximize your returns without taking on dangerous debt. Our fourth warning from Warren Buffett might seem obvious, but it's violated by millions of investors every year, often with devastating consequences. Don't invest in businesses you don't understand. Never invest in a business you cannot understand. Buffett has repeatedly advised. This principle has kept him away from countless investment fads that eventually collapsed, from complicated derivatives to speculative tech ventures with no clear path to profitability. The simple truth is that when you don't understand how a business makes money, you have no way to evaluate whether its current price is reasonable or ridiculous. You're not investing. You're gambling, hoping someone else will pay more for it later. This is the greater fool theory, not a wealth-building strategy. Consider how Buffett handled the original tech boom. While he's friends with Bill Gates and clearly understands the impact of technology, he largely avoided tech investments for decades because he couldn't reliably predict which companies would still be dominant in 10 years. He wasn't willing to pay premium prices for businesses with futures he couldn't clearly envision, regardless of how exciting they seemed. This doesn't mean you need to be an industry expert before investing, but you should be able to explain in simple terms how the company makes money, what could go wrong, and why you believe its competitive advantages will endure. If you can't explain it clearly to a friend, you probably shouldn't put your money into it. The solution is to build your own circle of competence, areas where your knowledge gives you an edge, and stick primarily within it. Start by investing in businesses that are straightforward and whose products or services you use and understand. As your knowledge grows, your circle can expand, but never feel pressure to invest in the latest trend just because others are excited about it. Now, let's examine Buffett's fifth warning, which challenges conventional wisdom about portfolio management. Don't over-diversify your investments. This might sound counterintuitive since we're often told that diversification is essential for reducing risk. But Buffett has a different take. Diversification is protection against ignorance. It makes little sense if you know what you're doing. The reality is that owning dozens or hundreds of investments often leads to average returns at best. True wealth building usually comes from making concentrated investments in your best ideas, businesses you thoroughly researched and strongly believe in. As Buffett puts it, put all your eggs in one basket and then watch that basket very carefully. Look at Berkshire Hathaway's portfolio. Despite having hundreds of billions to invest, Buffett keeps roughly 75% of his stock investments in just 5 companies he knows extremely well. He would rather have a smaller number of investments he thoroughly understands than spread his money across countless businesses he can't possibly track effectively. This doesn't mean you should put everything into a single stock. That's too extreme for most investors. But it does suggest that once you build a basic foundation, adding your 40th or 50th stock probably isn't making your portfolio meaningfully safer. It's just diluting your best ideas. A smarter approach is what some call the core and explore strategy. Keep a solid foundation, perhaps 70 to 80% of your portfolio, in broad index funds for basic diversification. Then concentrate the remainder in a small number of carefully selected individual investments where you have genuine knowledge and conviction. The sixth warning from Warren Buffett is perhaps the most difficult to follow emotionally, but it's often the most important for long-term success. Don't sell when the market drops. The stock market is a device for transferring money from the impatient to the patient. Buffett famously observed, "Yet when markets plunge, our instincts scream at us to take action and protect our money before it's too late." Here's the uncomfortable truth. Market declines are not just normal, they're inevitable. The S&P 500 has dropped at least 10% about once per year on average, and 20% or more every 3 to 5 years. These aren't anomalies. They're the natural rhythm of markets. The problem isn't that markets drop. It's how we respond when they do. During the 2008 financial crisis, when banking giants were collapsing and the financial system seemed on the brink of disaster, Buffett wasn't selling. He was buying. He invested billions in companies like Goldman Sachs and Bank of America when others were fleeing in panic. Those investments later yielded billions in profits as markets recovered, as they always have throughout history. The wisest approach is to view market declines as sales on quality businesses. If you'd be excited to find your favorite grocery items at a 20% discount, why would you be upset when the market offers the same discount on quality investments? As Buffett says, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. How did you react during the last major market drop? Did you sell in fear or buy the bargains? Type patience in the comments if you'd like to learn specific techniques for staying calm during market volatility. The seventh and final warning from Warren Buffett might be the most practical of all, especially in today's uncertain economic environment. Don't forget to build your emergency fund first. While Buffett is known for being fully invested in the market, he's also famous for ensuring Berkshire Hathaway always maintains massive cash reserves, sometimes over $100 billion. This isn't because he's worried about short-term market moves. It's because he understands that true financial strength comes from having enough liquidity to weather any storm and seize opportunities when they appear. The hard truth is that without adequate cash reserves, even the best investment strategy can collapse. Life brings unexpected expenses, medical emergencies, home repairs, job losses. And if you're fully invested with no cash cushion, you may be forced to sell your investments at the worst possible time, often during market downturns when you can least afford the losses. Consider what happened to many investors in 2020 when the pandemic hit. Those without emergency funds were forced to sell investments during the March decline to cover living expenses after job losses. Meanwhile, those with adequate cash reserves not only avoided selling at market lows, but often had the flexibility to buy additional shares at bargain prices during the downturn. Buffett applies this principle on a corporate scale by maintaining enormous cash reserves at Berkshire Hathaway. This allows him to pounce on rare opportunities, like during the 2008 financial crisis, when he secured exceptional deals from companies desperate for cash when no one else had liquidity to offer. The solution is straightforward but often overlooked. Before becoming fully invested in the market, build an emergency fund covering 3 to 6 months of essential expenses. Keep this money in high-yield savings accounts or short-term treasury bills, where it remains completely safe and readily accessible. This isn't money that will make you rich, but it creates a foundation of security that allows your investments to grow undisturbed through market cycles. Remember, the path to lasting wealth isn't just about what you invest in. It's about creating conditions that allow you to stay invested through thick and thin. An emergency fund isn't just financial protection. It's peace of mind that helps you make rational rather than emotional investment decisions. Now you've seen the 7 critical warnings Warren Buffett has for investors heading into 2026. These aren't complex trading strategies or secret stock picks. They're timeless principles that have helped build one of the greatest investment fortunes in history while protecting it through every market cycle imaginable. Remember, true financial success isn't about following the crowd, timing the market perfectly, or leveraging yourself to the hilt. It's about making rational decisions, understanding what you own, staying disciplined when others panic, and building a financial foundation that can weather any storm. Take a moment this week to review your investment portfolio with these warnings in mind. Are you chasing hot trends? Have you borrowed money to invest? Do you truly understand every business you own? Making even one adjustment based on these principles could save you from devastating mistakes and set you on a path to more consistent returns. Comment Buffett Wisdom below if these warnings have changed how you think about your investment strategy. I read every comment and would love to know which principle resonated with you most. In our next video, I'll share Buffett's approach to finding undervalued investments in today's market, including specific sectors he believes offer exceptional value despite the economic uncertainty ahead. You won't want to miss these practical insights. Remember what Buffett said: the stock market is a device for transferring money from impatient to patient. Your financial future isn't determined by market movements or economic forecasts, but by the quality of your decisions and your ability to stay the course when others lose their way. Follow these principles, and you'll be well on your way to building lasting wealth, regardless of what 2026 brings.